All right, for you folks who were behind a little bit in terms of getting to the homework, this is Chapter 7, the bond chapter, Homework 1. Let's go ahead and get caught up, make sure we're all caught up. So the first question is, what are the two forms of capital? And we've had that all semester long, debt and equity. Those are the two forms of capital. What is the first source of capital used by companies? And the answer is equity in the form of retained earnings. This is for companies that are up and operating, and hopefully they have some retained earnings. Okay? Why do lenders prefer that borrowers use some equity along with debt? They want to share the risk. They want to motivate the borrower. They want to make sure that the borrower has some of their own money in the game, and that will keep them motivated, working harder, and it will make it more painful for the borrower to simply walk away from the project. What form of capital is a bond? And the answer is debt. Bond is debt. What is debt typically related to? In other words, why do companies use long-term debt? Companies use external financing, debt, and equity outside of retained earnings primarily for long-term investments, otherwise known as property, plant, equipment, or CapEx. Sometimes they use it for acquisitions, mergers and acquisitions, but they're making long-term investments. Okay? So describe what a bond is. A bond is a contract, and it is a loan. It is debt between the borrower, which is the issuer of the bond, the company, and the investor, who is the lender. It's a direct loan. All right. From a legal and from a tax perspective, how do bond interest payments differ from dividends? Okay, legal and tax. So legal, okay, interest is a legal obligation. Dividends are not until the board meets and declares them. So the board will meet every quarter and decide if it is prudent to declare a dividend, and only after the dividend is declared does it become a legal obligation, whereas once the contract is signed between the issuer and the lender, the investor, then those interest payments become legal obligations. Now, interest is deductible from income, okay, which lowers your taxes. Dividends are not deductible. Okay? All right. Explain how cash flows are more certain, cash flows from bonds are more certain than cash flows related to stocks. Well, the cash flows on a bond are spelled out, they're specified. The amount and the timing are specified in a legal contract, whereas dividends and the amount you're going to get back when you sell the stock eventually, they are not spelled out anywhere. So there's no certainty about dividends and the payment, the cash flows related to a stock, whereas the cash flows related to a bond are spelled out in the contract, and unless the company goes bankrupt, and even if they go bankrupt, you'll have a better position than a stockholder to try to collect when the company goes bankrupt and has to liquidate their assets. All right. Since debt is cheaper than equity, briefly explain why companies don't put as much debt on the balance sheet as possible. Well, we covered this in the ratio chapter. The more debt you add, the larger your legal obligation becomes, the larger your fixed payment for interest, and then your principal payment when it comes due, it's not related to sales, and so it really puts you at risk. If sales turn down, you're at risk of going bankrupt. Okay? So the more a company borrows, the higher the interest rate gets. The lenders will start charging a higher interest rate on the new debt and on the existing debt, and also the stockholders will become concerned, and many will probably sell their stock and push the stock price down. So that's a cost of debt. as well. So there's only so much debt a company could put on its balance sheet. All right. A company pays $70 each year on each $1,000 bond that is outstanding. Okay? So let's find the pre-tax cost of the bond. It's 70 divided by 1,000 equals 7%. That's the pre-tax, that's the APR on the bond. Okay? The company is in the 21% tax bracket. What is the after-tax cost of the interest? Okay, so we're going to multiply 7.07 times 1 minus the tax rate, and we'll get our after-tax cost of debt. So, let's clear this calculator out. 0.07 times 0.79 is 5.53%. That's the after-tax cost. That's the real cost, because you get to deduct your interest payment, and therefore you're going to save on taxes, and your after-tax cost, in dollars, it would be 70, times 0.79, and that would be $55.30, which is 5.53%. All right, let's look at homework 2. So question 1 is redundant. What is a bond? We've already answered that. What is the typical denomination of a bond? Each bond typically has a value on the face of the bond of $1,000. Okay? A firm wants to raise $1 million in debt. How many bonds would they have to sell? Well, let's divide $1 million by 1,000, and we get 1,000 bonds. You sell 1,000 bonds at $1,000 each, and you raise $1 million. Okay? What is a bond indenture? The word indenture means contract. This is where all the text is, all the narrative is. This is where the bond attorneys write the contract. What is the face value, the par value or face value of a bond? It's the denomination of the bond. It's the amount that will be paid back for each bond. It's $1,000. Okay? What is the maturity date of a bond? The maturity date is the date on which the issuer will pay back the $1,000 per bond. What is the term to maturity of a bond, and what happens to it over time? Well, the term to maturity is the time between some specified beginning point, that could be today, it could be a year ago, and the maturity date. So this period right here is the term or time to maturity. So each day that passes, this time gets 1 day shorter. Each year that passes, let's say it's 10 years. In a year, starts off 10 years. In a year, it's going to be 9 years. In 2 years, it's going to be 8 years. All right. What is the coupon rate on a bond? Okay. The coupon rate is the rate that the issuer promises to pay periodically, either annually or quarterly or semi-annually or monthly, to the investor, to the buyer of the bond. It is specified in the contract, the coupon rate. What will the rate be? How do you compute the dollar amount of periodic interest on a bond? Well, you take the annual rate and you divide it by the number of periods per year for the bond. So let's say it's quarterly. Then it would be, so let's say it's 8%. Let's say the annual rate is 8%. And let's say the face value, the par, is 1,000. So the annual payment would be 0.08 times 1,000 equals 80, divided by 4 times a year. The periodic interest payment would be $20. Okay? is the market rate for a bond, and how does it differ in terms of its use from the coupon rate? Well, the market rate is the interest rate that's being paid in the market, the agreement between buyers and sellers, for similar bonds. What would you have to pay if you were an issuer of a bond? When a bond is first issued, the market rate equals the coupon rate. The investment bank that determines, that does the bond issue, looks at the rates that are being paid on similar bonds, and they use the market rate to set the coupon rate. So the coupon rate is stated in the contract. It does not change over time unless it's an adjustable rate bond, which we'll cover later in this chapter. But so it stays the same. But after a bond is sold, interest rates change every second of every day. The market rate changes. The coupon rate does not change. So that leads to the next question. Describe how you find the market value of a bond. Okay, so we're going to use the coupon rate and the market rate to find the value of a bond. The market value, let's call it market value, equals PO, the price we should pay right now, and that is equal to the present value of the coupon payments plus the present value of the principal payment. Okay? And so we need to find the coupon payment, and the coupon rate is used to find the coupon payment. And to find the present value, we're going to divide that by 1 plus our IY. And our IY is not our coupon rate. Our IY is the market rate. That's what the market rate is. Okay? All right. So the market rate is the discount rate used to find the present value of the payments. And the coupon rate is the contractual rate that is used to compute the periodic interest payment. Okay? So let's work an example or two. It'll help you understand it when we work a couple of examples. A bond currently has a par value of 1,000. So we're going to call that 1,000 plus minus is a present value. Coupon rate is 6%. Therefore, 0.06 times 1,000 equals $60 a year. How often does it pay? Quarterly. Divided by 4 equals 15. And that is our payment. Okay? The term to maturity is 5 years. Times 4 payments each year is 20, is our N. Okay? Compute, so we need our IY. So 7.5 is the market rate. Let's find the quarterly rate. 7.5 divided by 4 equals 1.875. That is our IY, that's our quarterly IY. Compute present value. Okay, so let's find the present value of all this information here. All right, so 1,000 plus minus is our present value. 20 is our N. 15 is our payment. 1.875 is our IY, compute present value. I'm sorry. Pardon-moi. I made a mistake here. The 1,000 is not a present value. I misread the question. The 1,000 is the par value. That's our future value. So I made a mistake. So let's make sure we get this right. 1,000 is our future value. That's what we're going to get when the bond matures. And 15 is our payment, 20 is our N, 1.875 is our IY, compute present value, and we get $937.94, and that is less than 1,000, and the reason it's less than 1,000 is that the coupon rate is less than the market rate. They were the same when the bond was issued, but after the bond was issued, this didn't go down, this went up. Interest rates go up, present value goes down. Anytime a bond price is less than 1,000, that means the market rate is higher than the coupon rate. Market rates have gone up, and the bond present value or market price goes down. All right, let's work another problem. A bond currently has a par value of $1,000, so $1,000 is going to be our future value. The coupon rate is 6%, so 0.06 times 1,000 equals 60 divided by, let's see how often it's being paid. Being paid quarterly, so it's still 15. That's our payment. Okay. Term to maturity is 5 years, so 5 times 4, so nothing's changed here. 20 is our end, but one thing has changed. Our IY is 5% instead of 7.5%. So our IY is 5 divided by 4 equals 1.25. So now our market rate is below our coupon rate, which means interest rates have gone down. So when we say compute present value, the bond will trade at a price higher than $1,000. Compute present value, so let's go ahead. The only thing we have to change here is our IY, so 1.25 is our IY, compute present value, and we get 1043.99. Okay? Actually, it's 1044. Let's round up. 1044. So that is greater than 1,000. Okay? Because interest rates have gone down, the IY, the market rate, has gone down, is now below the coupon rate. When the market rate goes down, the present value goes up. All right. If the current market price of a bond is greater than 1,000, the bond is said to be trading at a premium. Premium. Okay? What do you call a bond that has a current market price below the par value? So less than 1,000, discount. Okay? So there you have it. Homeworks, let's see. We have something else here. Looks like we might have. Nope, we're done. So chapter 7, the bond chapter, homeworks 1 and 2. And so everyone should be up to speed, and we will cover tomorrow, in the Monday, Wednesday, Friday class tomorrow at 8 and 9, we'll cover homeworks 3 and 4 for the bond chapter, and then we'll cover homework 5 on Wednesday, and then we'll also cover homeworks 1 and 2 from chapter 8, which is the stock chapter. So I'm going to get those videos done for the stocks, and we'll get moving for Wednesday. And then the Tuesday, Thursday class, we'll cover homeworks 3 and 4. Yeah, correct. Homeworks 3 and 4 for the man, I've lost my train of thought. So we'll cover 3, 4, and 5 on Tuesday in the chapter 7 bonds, and then we'll move on Thursday, and we'll cover homeworks 1, 2, and 3 from the stock chapters, chapter 8. Okay, so I'm trying to keep everybody together. All right, I hope that was clear enough, and we will see you tomorrow or on Tuesday. Y'all have a good night. Shalom.